Imagine being an investor, scanning the horizon for the perfect company to invest your hard-earned money in. You're not alone. Successful investors like Warren Buffett have been doing this for years. Fundamental analysis. It's like a detective's toolkit, helping you dig into a company's financial health and value. But it isn't about quick wins. No, it's about assessing the long-term prospects of a company. It involves meticulously analyzing financial statements, earnings per share, price-to-earnings ratios, dividends, and other key metrics. It's about understanding the company's industry, its competitors, and the overall market conditions. It's about making informed decisions, not based on market rumors or short-term price movements, but on solid, verifiable data. So how does one dive into the sea of financial data and emerge with clear investment decisions? Let's explore. Scene script. Picture yourself opening a company's annual report, pages upon pages of financial jargon. Intimidating, isn't it? But not anymore. Let's demystify this. Take a deep breath and dive in with me. Imagine we're looking at Apple Inc.'s financial statements. There are three key components we need to focus on: income statements, balance sheets, and cash flow statements. First, the income statement. This is a company's report card, showing us the profitability over a specified period. It's all about revenue and expenses, profits and losses. Next up, the balance sheet, a snapshot of a company's financial health at a particular moment. It showcases assets, liabilities, and shareholder equity, giving us insights into the company's stability and growth potential. Finally, we have the cash flow statement. This reveals the company's ability to generate cash, a vital sign of its financial health. It's like the company's heartbeat, vital and revealing. The ability to understand these financial statements is akin to having a decoder ring for a company's financial secrets. Now, armed with your decoder ring, you come across terms like EPS and PE ratio. Confusing? Not for long. Let's imagine we're looking at two companies, say Amazon and a local mom and pop store. We want to know which business is more profitable. This is where earnings per share, or EPS, comes into play. It's essentially the portion of a company's profit allocated to each outstanding share of common stock. So if Amazon has a higher EPS than the local store, it means Amazon is more profitable. But how do we know if Amazon stock is overpriced or a bargain? That's where the price to earnings, or PE ratio, steps in. It's a simple calculation. You take the current stock price and divide it by its EPS. The resulting number tells you how much investors are willing to pay for each dollar of earnings. A high PE ratio could mean that the stock is overpriced, or investors are expecting high growth rates in the future. Let's say Amazon has a high PE ratio, while the mom and pop store has a low one. That doesn't automatically make the local store a better investment. It could just mean that investors have high growth expectations for Amazon. In essence, EPS helps us understand a company's profitability, while the PE ratio gives us a sense of market perception. With the power of EPS and PE ratio, you can compare apples to apples in the stock market. Now imagine a company not only thriving, but also sharing its profits with its investors. That's the allure of dividends. Dividends are a portion of a company's earnings distributed to shareholders. They're like the icing on the cake, a sweet payment that rewards you for your investment. Think of a company like Coca-Cola, which has a long history of paying dividends. This consistent payment history is a testament to Coca-Cola's profitability and stability, making it attractive to investors who appreciate a steady income stream. But how do we measure the attractiveness of dividends? Enter dividend yield. This is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's typically expressed as a percentage. For instance, if a company's annual dividend is $2 per share and its stock price is $40, the dividend yield would be 5%. A higher dividend yield can suggest a good investment opportunity, but it's not the only factor to consider. It's also crucial to assess the company's overall financial health and growth prospects. After all, dividends are only as reliable as the company that pays them. So by understanding dividends and dividend yield, you're not only investing, but also earning while you hold your stocks. It's time to apply these insights and make savvy stock market decisions.